Imagine this. The U.S. national debt has skyrocketed past $33 trillion, and the country is now paying more in interest than on defense or Medicare. Inflation has been wreaking havoc. The stock market is at historically high levels, and Warren Buffett, one of the world's most trusted investors, is selling off nearly $100 billion in stocks. The man known for his buy-and-hold philosophy is offloading massive amounts of stock while sitting on a $276 billion cash pile, signaling something far more ominous than just routine portfolio management. What does Buffett see on the horizon? And what does this mean for the future of the American economy? Warren Buffett, one of the most successful investors in history, recently made a massive move by selling an eye-popping $97 billion worth of stocks in the first 6 months of 2024. To put this in perspective, that's nearly $100 billion in sales from one of the most renowned buy-and-hold investors, a man known for his aversion to short-term market timing. So why is Buffett, who famously advises against trying to time the stock market, selling off so much stock? Let's break this down. For context, let's look at Buffett's history of stockpiling cash before major market downturns. Take a glance at the chart tracking Berkshire Hathaway's cash position and the performance of the S&P 500, the most widely used index of the U.S. stock market. There's a clear pattern. Buffett tends to accumulate large cash reserves before stock market crashes, positioning himself to swoop in when prices drop. Let's rewind to the early 2000s during the dot-com bubble. Buffett wasn't caught up in the euphoria. While others were investing heavily in tech stocks, Buffett was busy amassing cash. By the time the bubble burst, Berkshire Hathaway's cash reserves had grown tenfold, allowing Buffett to buy stocks at bargain prices when the market collapsed. The same thing happened during the 2008 financial crisis. As the market surged before the crash, Buffett's cash reserves rose with it. When the crash hit and the market lost 50% of its value, Buffett had a significant cash pile, which he used to make some of the most iconic investments of his career. Now let's bring it back to today. Buffett's current cash position dwarfs those of the past. Berkshire Hathaway now holds an incredible $276 billion in cash, nearly tripling from $100 billion just 2 years ago. What's more, Buffett has been rapidly selling stocks, which is unusual for him. His typical approach to accumulating cash is more gradual, as Berkshire Hathaway's businesses generate profits, which naturally add to the cash pile. But this time, Buffett's selling stocks at a pace we haven't seen before. He's even selling stocks in companies that he previously said he planned to hold indefinitely. One of the most striking examples of this is Buffett's recent sale of a substantial portion of his stake in Apple, a company he has referred to as one of Berkshire's family jewels. Buffett has repeatedly sung Apple's praises, calling it one of the 4 key pillars of Berkshire's long-term success. Yet, in the first half of 2024, Buffett sold $90 billion worth of Apple stock. For a man who once implied that Apple was a stock he planned to hold for the rest of his life, this sudden shift is notable and concerning. So, what changed? In a public statement, Buffett attributed part of his decision to sell Apple to taxes. He pointed out that Berkshire Hathaway is currently paying a federal tax rate of 21% on its capital gains, compared to much higher rates in previous decades. He speculated that given the current fiscal policies and rising national debt, higher taxes are inevitable, and that selling now at the lower tax rate might make sense. Buffett's point is valid. The U.S. government's debt-to-GDP ratio is at a record high, surpassing even the levels seen during World War II. For the first time ever, the annual interest payments on the national debt have exceeded what the government spends on both defense and Medicare. Buffett's argument seems reasonable on the surface. Sell now while the tax rates are favorable, rather than later when taxes are likely to be higher. But is that the whole story? If we look deeper into Buffett's career and past statements, this explanation raises some eyebrows. In 2011, Buffett wrote an op-ed for the New York Times titled, "Stop Coddling the Rich." In it, he argued that wealthy investors like himself should pay higher taxes on capital gains and dividends. He made it clear that higher taxes have never deterred him from making investments. He even pointed out that back in the 1970s, when capital gains taxes were nearly 40%, he and other investors still made smart investments without hesitation. So, why is Buffett suddenly so concerned about taxes now, after a lifetime of not factoring them into his investment decisions? The tax explanation, it seems, might just be a convenient excuse. The real reason Buffett is selling large portions of his stock holdings is more unsettling. He believes the stock market is overvalued. Let's go back to Apple. When Buffett initially bought a significant stake in the company between 2016 and 2018, Apple's price-to-earnings (PE) ratio was in the range of 10 to 15. At the time, many investors viewed Apple as a hardware company at risk of losing market share if a superior product came along. In other words, it wasn't highly favored by investors, but things have changed dramatically since then. Apple is now universally recognized as one of the best companies in the world, and its PE ratio has ballooned to over 30. In other words, Apple stock has become much more expensive compared to its earnings. By the end of 2023, Apple made up a staggering 22% of Berkshire Hathaway's total market value. That's an enormous concentration in a single stock, even for someone like Buffett, who tends to concentrate his investments in a few key holdings. The concern about overvaluation was too big to ignore. While Buffett cited taxes as the reason for selling Apple, the real motivation likely stems from the fact that Apple, along with many other stocks, may be overvalued. Buffett's cautious approach extends beyond Apple. Over the past 2 years, he has been relatively quiet in terms of making new investments. His famous ability to spot undervalued opportunities seems to be on hold, and he's sitting on a massive pile of cash. Why? Because he believes stocks in general are overvalued right now. To understand why Buffett is being so cautious, we need to look at what's known as the Buffett indicator. This is a ratio that Buffett himself has referred to as the best single measure of where stock market valuations stand at any given moment. The Buffett indicator compares the total value of the U.S. stock market to the size of the U.S. economy. If the stock market is growing faster than the economy, it could signal a bubble. As of 2024, the Buffett indicator sits at a whopping 202%. That means the stock market is valued at more than twice the size of the U.S. economy. To put that in perspective, the last time the Buffett indicator was this high was in 2021, just before the market suffered one of its worst years on record. In 2022, the S&P 500 dropped nearly 20%, and the Nasdaq fell by 33%. Historically, when the Buffett indicator gets this high, it's a warning sign that stocks are overvalued, and a correction may be on the horizon. Buffett's decision to hold on to cash rather than jumping into new investments suggests he's expecting a downturn. He doesn't see attractive opportunities right now, and that's telling. This cautious approach might be frustrating for some investors who want to see Berkshire Hathaway make big moves. But Buffett's patience has served him well in the past. He's willing to wait for the right opportunities, even if that means sitting on the sidelines while others rush into the market. Of course, none of us can predict the future with certainty, but if history is any guide, Buffett's actions should give us pause. When someone like Warren Buffett starts selling off stocks at this scale, it's worth paying attention. The market may be overvalued, and if a correction is coming, those who aren't prepared could find themselves facing significant losses. In the end, Buffett's message is clear. Be patient, be cautious, and don't get swept up in the hype of a rising market. Holding on to cash and waiting for better opportunities might not be exciting, but it's a strategy that has served him and his shareholders well over the years.